Good afternoon, YouTube. Welcome to the Goofy Investing channel, where we talk about stock market investing. This video is going to be an analysis on ADMA stock, ticker ADMA. It was ADMA Biologics Incorporated, per subscriber's request. So let's get straight into it. This is a biotech company that is headquartered in Ramsey, New Jersey, and they specialize in autoimmune deficiency stuff such as more so hepatitis B, which is the disease that they target. And you know that's pretty much their whole thing. They provide they provide treatment for it, for some sort of drug and research and so forth. All right. And they provide the supply for it, if you will. All right. So let's take a look real quick. Let's take a look generally at their financials. Revenues seem to be going good. It's a post-revenue company. Seems to be a lot of growth here. All right. Shares outstanding, diluted shares outstanding, seems to be a lot of dilution happening, but that's typical with these younger biotech companies because they raise a lot of equity and so forth to continue pre-profit to continue the research and development. All right, and there's a lot of tax benefits that these biotech companies get to capitalize off of, due to, governments helping the biotechs, allowing pre-investor capital, because research needs to happen. There's highly regulated stuff happening there, if you will. So let's look at that in terms of profitability. Gross profit's 40%. Net income's right there teetering between a profit. If we go back to their financial statement, and we go back to their cash flow statement, it looks like they're very close to profitability. In fact, they're probably hitting profitability on a quarterly perspective, barely, depending on which quarter. So as you could see, and we go to cash flows, it seems like it's a little up and down with profitability in the cash flows. Eventually, year after year, even these weak quarters will turn into profitable quarters, as you see. All right, let's look at our earnings. All right, earnings estimates. EPS. All right, looks like there's positive EPS happening, so there's profitability projected through consensus estimates. Let's do some quick math. Share price is $10.99. Obviously, the market just closed. So let's add it up to how much EPS will the earnings yield up to 10%. All right. Well, looks like after 2020, by the end of 2026, you'll hit that, or 2.5 years in, you should be, these shares should earn back 10% of what the price is right now. All right. So from an actual forward price to earnings growth perspective to the PEG, let's look at that. All right. So we're consensus estimates of 30 forward PE, and analysts consensus estimates of growth of 38.45%. The PEG is below 1 this year. All right. Next year, the PEG is over 1, as there's about shy of 16% projected and a forward PE of shy of 20% projected. Okay. So, and as you can see, the growth does stagnate a little bit into the single digits. Now, the further the analysts project out year after year, after 4, 5, 6, 7 years, etc., these growth estimates get more hazier and hazier because you can't tell the future. All right, it gets harder and harder the more further out you get. So these numbers can all be wrong. They can all look like 20% growth or what have you. You don't know. You don't know if this company will come up with the next cure to whatever, treatment to whatever, another disease, and next thing you know, they're on the market after they get through the clinical stages of whatever vaccine or whatever. All right. Let's look at this balance sheet here, which, of course, I did my due diligence. I did my homework prior to this video. We got a net debt position here. There's 141.43 million in debt, and they have 45.33 million in cash. If the company is in a net debt position and they are not completely profitable, and they are teetering on the lines of being profitable, I take more of a cautious stance. All right, especially if you don't have the 4 quarters of free cash flow and free cash flow growth. All right, to service whatever debt obligations. And the devil is in the details. So let's look into the details. I pulled up their 10K. All right, and first of all, on a prior video, I demonstrated that there was a problem in the auditing portion on a prior company. This is an example of what it should look like that checks the block. All right. So in the actual 10K, when they do the audit, and an audit will be done on the annual 10K, not the 10Q. The Qs are not audited. Only the annualized 10Ks are audited. All right. Or the company gets the audit annually. All right. Typically, they'll get a letter of confirmation that the company has been audited in accordance with the PCAOB standards, and this is what it looks like. All right, it pretty much says it verbatim. We conducted our audit in accordance with the standards of the PCAOB. This is an actual interjected letter from the actual auditing firm into the 10K. And when you go down, there will be there it is. There is the person in charge of the auditing. All right, and they pretty much said they've been auditing this company since 2008. So on an aspect of the fidelity of the numbers being accurate, we can take it to the bank. This company's audited, unlike that other company I was looking at from Israel. All right, and even on the 20Fs. On foreign companies, they will have this letter too from a company that is under the PCAOB. So that'll check that block, if you will. All right. Now that we've got that out of the way, let's look at the debt and the details of the debt. All right. So Ares Capital is the lendor. All right, and I'm not going to read all this verbatim, but I'm going to sum it up. All right. I don't like the terms of the debt. All right. You have some senior secured credit facilities. All right. But they're not in the term of senior secured notes. Senior secured credit facilities are SOFR instruments. And you'll see that with their adjusted term SOFR. These are pretty much, think about a credit card that's secured off some collateralized investment. So far, credit term facilities are backed by U.S. Treasuries, and there are floating rate percentages. All right, and it actually gives out kind of a range. Right here, it looks like 11.8% credit facility down to was 9.12%. And they'll say on the annualized 10K, this is how much interest we paid and so forth. All right. So whenever you see so far, you automatically know it's a U.S. based crediting derivative deal. It's based off U.S. Treasuries, and there's several hundred basis points above the actual Treasury notes yield. So that way, the interest on the spread is advantageous to whoever the lender is. All right. But the actual deal here is and this is why I don't like the deal on the actual debt credit facility, is they actually have the way they structured this debt is the credit facility never wants them to pay the debt off. They want the debt to stick in perpetuity, like pretty much. Like if you look at it, and how do I know? It's because they have these prepayment penalties, and there's a prepayment penalty of 11 million to pay the debt, and then there's an additional 1.6 million exit fee to close the debt out on all accrued and unpaid interest. All right, so there is, so they're going to get the full amount of interest maximum regardless, and that's part of the deal. When you're one of these companies that's not profitable, a lot of the time, if you can't raise capital via equity, these are the type of deals you get on the debt market. And I'm thinking this is probably what happened. They had to resort to go into this and so forth. All right. So if you're not profitable company, debt is not the way to go, because you have to pay the debt off. All right. Or you have to maintain the interest payments on the debt. So that's why equity is more advantageous if you're not profitable. On the flip side, if you're profitable and you're growing and so forth, and you have free cash flows, maybe some debt might make sense, because there's a spread between the fixed rate of debt and your growth rate and your variable growth rate in equity. So that might be a value creation aspect. So, but yeah, that's my take. I don't like the debt. All right, let's look into the actual quantitative or the qualitative aspect of the business model, which is the hepatitis B disease. All right. So I did some research. It looks like there's about 254 million people that are living with this disease. And of those, not everybody has insurance, but of those that have the insurance, they're mostly on Medicaid, lower income, if you will. So with these people and the insurance and the way the insurance pays out on the hepatitis B, and I just do research through, National Library of Medicine and so forth. Okay, so according to this, over 25% of these actual insurance plans, they require evidence of liver damage. And there's a lot of different things that can cause liver damage, all right? And including drug and alcohol can cause some liver damage stuff happening, all right? And pretty much if there's evidence that there's drug and alcohol, liver damage stuff happening, the insurance can say, oh, that was part of our restrictive clause. We're not going to cover it because you drank alcohol and you did drugs or whatever. And you look at the actual causes of hepatitis B. Yes, there's a lot of sexual transmitted disease type stuff happening, but a lot of it is drug related, like sharing needles and and so forth. And let's get real. I mean, people drink all the time. All right, alcohol is legal everywhere, and what do people like to do when they get drunk? They have sex, all right, and they have sex with people that maybe they shouldn't be having sex with. I don't know, all right. So, I mean, me personally, I don't like the actual I don't like the setup. I don't like the debt structure. And this is my take on the actual biotech industry. There are like hundreds of these companies everywhere. All right, they're a dime a dozen. I mean, if I was gonna, and you know what, finding the winner in the biotech, it could be very lucrative on the actual returns, but but to find the winner in a biotech company in this whole industry, it's like finding a needle in the haystack. All right, that's kind of my take on it. So The only biotech pharmaceutical companies that I'm really interested in are ones that yield. And when I'm more of a mature investor in later stages where my growth is already had and I'm just trying to get some yield, and I'm buying Merck for a dividend off of, and because I'm more mature investor, and I'm trying to, and preservation of capital is more important than growth of capital at that phase when I'm older. So that's kind of the only way I'm interested. If I were to invest in a biotech company, it would be in the weight loss category. All right. I'd be looking in, me personally, I'd be looking into a biotech company that is focused on weight loss medications and treatments because of the obesity issue in the United States and in the world. And I think the massive TAM for that is crazy. People will do anything to lose some weight without actually exercising. All right. But that's my take on it. Sorry the video ran a little bit longer. Me personally, not for me. Um, and there's plenty of biotech companies out there with net cash, better growth rates, and so forth. I was looking into their peers, and this one right here, TG Therapeutics, was the one that caught my eye. All right. So maybe look into that. All right. So with that being said, thank you all for thank you all for being viewers and subscribers. If you haven't done so already, please subscribe and hit the bell notification. If you want me to look at another company, I listen to the people, so put it down in the comments. You know, if you want me to do an analysis on another company, I'll be more than willing to. I listen to the people. Check out my Patreon in the link below on my actual the link dashboard when you click on it, and join the Looney Syndicate. There's a lot of good stuff happening in there. You'll get access to instructionals, the hidden gem collection, actual community of like-minded investors, and more exclusive access to me and additional investor. In addition to actual instructionals, I actually have some tools on there like spreadsheets and so forth that I use. So check that out. Become a member. And with that being said, enjoy the rest of y'all's week.